So do you want to know the secret, the key to staying in winning trades longer so that we can maximize and increase our profits? Yes, we're talking about when we're in a trade, the market's moving in our direction, and we want to increase the profits of the trade that we're in and not put ourselves in a position where we're getting stopped out, where we can pick up another 10 points possibly. There is a strategy in how I trade on a daily basis, all surrounding supply and demand. Sometimes I take liquidity sweep setups, but it doesn't really matter. Once we're into the trade, we need to know how can we stay in that trade longer so that we can get as much as we can out of that trade possibly, right? Now, the market is going to do what it wants to do. Sometimes we get some wacky stuff that happens in the market. We could be in a nice trade and then it swings back in the opposite direction and stops us out. So if you're trading with hard stops, I'm going to show you a technique, a strategy that you can possibly use in your own trading so that you can come out on the better end of things and profit as much as you can. I talked about in the video yesterday about narrowing or minimizing the number of trades you take. You don't have to take 5, 6, 7, 8, 9, 10 trade setups a day. Sometimes it's just one and done, maybe 2 or 3, depending. Maybe you have a set goal, as far as how much you're looking to make on a daily basis, or maybe on a weekly basis, however you look at it. Maybe you trade part-time, full-time, whatever it may be. The key to really succeeding and getting as much as you can out of a trade, again, staying in that trade to maximize the profits, is really basically trailing behind price and knowing the areas where to set your stop loss, or maybe your mental stop, when as the market's moving down. So, as the market is moving lower and we're swinging, you should know where to kind of position a stop at, so that, you can at least get out of that trade in that area there if the market swings back pretty heavy, so that you lock in some profits. You don't want the market to come and take everything that you just made in that winning trade. All right, so we're going to talk about that. How can we let our winning trades run longer right now? So stay tuned as I go ahead and kind of get things prepped up here. We're going to look at my Nasdaq charts. We're going to look at a higher time frame, a 60 range chart. I trade range-based charts. People ask me all the time why. There's no rhyme or reason. It's just simply the fact is, I like to see things that are cleaner to the eye. I like to make my trading as simple as possible, and range charts do that for me, okay? I'm not saying I possibly can't trade from a time-based chart, and if you trade time-based or tick charts, volume charts, that's fine. I'll always tell people stick with what works for you as long as you're consistent in your trading each and every day. So let's start off with my higher base chart. I'm going to move on down now here to my 60 range chart. This is a trade setup that I posted over on the Discord community, and if you're not a Discord member, please find the link down in the lower portion of this video, down in the description. Click on it and invite yourself in. The Discord is free of charge, okay? There's no fee, okay? So this area right here was a liquidity sweep that I posted a trade that I went short on, and this could just as well been a supply or demand setup. Doesn't matter. 98% of the time, the way I trade is around supply and demand. But if I see a great liquidity sweep setup, I'm going to take it. All right. So take a look at what's going on here. We always want to take a look at our the structure of the market first. If you do not understand market structure, please stop right now. Continue watching the video, of course, but please understand, learn, educate yourself on market structure. It is everything. It's going to be the gateway, the key that unlocks the door that's going to make the difference of you succeeding or failing in this business of trading. Okay, so look what we have here. What can you tell me that you see going on right now? I'm going to give you 3 seconds. All right. 2, 3. All right. So we see the market moving in what? An upward direction. Lots of us can see that to the eye, right? We can tell when the market's moving higher, when it's moving lower, because most of us by now can understand the idea of higher highs and higher lows, or lower lows and lower highs if we're moving to the downside. And if we're moving to the upside, making higher highs and higher lows, what are we looking for on a daily basis? We're looking for demand setups, unless there's some liquidity sweep or that we're looking to maybe take a short off of, where the market is basically bumping up against an area, say, of resistance. It could be a supply area off to the left-hand side of the chart, and it can't push through that. It just sweeps right above it, and then we can look for a setup to go short. Now, if I was to take this chart here, the 60 range chart, which is my higher base and my higher time frame chart, and then bump it up to maybe 120 range or something slightly higher, I would see where the market structure, the market was just swinging to the upside. There was no breaker structures below, okay? Because typically when we see a breaker structure off of the market, or coming off of where the market is making higher highs and higher lows, and then it breaks structure to the downside, then your mindset should shift. Your bias should shift from taking long positions to short positions. So what we can see unfolding in this opportunity here is the market making higher highs and higher lows. Simple as that, okay? Just kind of, don't really pay attention to these boxes right here. Pay attention to the one where it says liquidity sweep here, because this is the example I'm going to show in this video. But again, this could just as well be a demand or supply setup, all right? But we're breaking structure to the upside in this case right here. And if you notice, as we made this high right here, the market pulled back, okay? We did break a bit of structure to the downside. Maybe you started taking or looking for some opportunity to go short. But then as we push back up, what do we start doing? We started kind of ranging, right? We kind of ranged in this area here from February the 7th into the 8th, early hours of the 8th, right before the market opened up, and then we started slamming to the upside, back to where it broke above this area of structure at 875 or 876, we'll call it that. But look what happens. The market pushes up. It starts to break and take out smaller areas of internal or minor areas of structure, and then it pushes higher. It makes a new high right here. We broke above 876. Made this new high here. Then what happened? We pull back, and then what do we do right here on the next push to the upside? See that candle there, that bearish candle? The wick of it broke above this area here. So we broke right above 894 and a quarter, 894 and a half. So that's a breaker structure to the upside. But we didn't break and close to the upside. We actually just swept above that area. So when I saw that, and before this actually happened, what I saw was this right here. Pay close attention. We made a high here. The market pushes down. We push up here. We got equal highs resting right here. The market pulls back. Another one. Pulls back. Boom. We break. So we're in areas where you see equal highs or equal lows resting at, and the market sweeps right above them. That's what we like to classify as liquidity sweeps. Some call it liquidity grabs. The market is just sweeping right above a set area of equal highs or equal lows. When we see opportunities like that, you should kind of think, okay, is the market just really trying to grab what it's going to get, grab liquidity and fold back the other direction? In this case here, this is exactly what it did. It swept above some equal highs right here with that wick of that candle there. Now, we're not going to take the trade off of our higher time frame chart. We're going to move down to my 12 range entry chart. That's the chart I take my trades from, okay? This was that area right here. Right here. This is where the market swept that high at on the higher base chart. Now, when I see a liquidity sweep up to the upside, or it could be to the downside, in this case here is to the upside, where the market is taking out equal highs, what I want to see, just like I do when I am marking supply or demand zones off of my higher base chart, I want to see on my lower entry chart where the market breaks structure on the lower time frame, my 12 range entry chart, because this is what's going to let me know if we get a nice supply setup in this case here to be able to go short. So a breaker structure lower on the lower time frame or lower base chart where we get a nice supply setup. So look what happened. It swept the high here. It pushes down. We've got aggressive selling. If you know about supply and demand, what is aggressive selling? That's supply. It broke structure right here, broke through the swing. It pulls back. What do we have in this area right here? There's an area of supply. I'm going to bring this down right here. Supply right here. The market pulls back on my lower base chart, my lower time frame chart, 12 range. What I like to see then, once it sets itself up at an area of supply, okay, we got aggressive selling, the rejection, not the rejection, but the breaker structure lower, supply area, supply zone created, and then all I want to see is a break and a close of a candle lower to the downside. So let's kind of blow this up a little bit so you can see what I'm talking about. All right. Break and close of a candle. Now, this is a bearish hammer candle. When we see that lots of times, what do we kind of, what does that signify in a sense? Momentum to the downside. The market taps, and this is a good thing I love to see when a market taps into a zone. In this case here, off a supply zone. When the market taps it and doesn't break into the zone, deeper into it, but wicks away from it, meaning we tap into it with the wick, breaking in the opposite direction with the hammer to the downside, that's a momentum bearish candle to the downside. It closes. But yeah, if you're aggressive, you can enter there, going short. But if you're more conservative, then wait for the break and close of the candle, meaning the break and close of the last bullish candle to the upside. This candle right here, the bearish candle here, where it closes at 886 and a quarter, go short there. And if you do so, you can see where the market just ran to the downside right here. All right. If we go back to a higher base chart, I'm going to show you. I always talk about being able to gauge before you get into a trade where the market could actually go down to, right? Where it could actually move to your target, right? So where the market was pushing up here, we're back on the 60 range, higher time frame chart, or higher base chart. And the market pulled back here. What did it do here? It started closing in areas of imbalance. It closed this area here. Feel that gap right there. And it pushed a little lower, tapping into what? This area of support right here. Okay? So feel this imbalance here. Went up there and swept that area there. I see that it feels this imbalance here. It's testing this area of support as well. Where's the next area that's going to test below that? It's going to try to come down here and feel this imbalance right here between this candle here and this third candle here. The close of this candle here, the bottom end of the wick of this candle here, there's an imbalance. There's a gap resting right there. I always talk about imbalances. They're a crucial part of trading. So we get in this trade in this area here. Go back to the lower time frame. What are we aiming for? This imbalance resting right here at 50, just like I said. And 50 is a half number too, so you must keep in mind that the market can reject when it hits that area, and it does. It bounces there. It bounces right off the VWAP too. Now I don't trade based on indicators, but you know, as long as, say for instance, if people do like to trade EMAs, for example, or maybe even SMAs, the VWAP is a good indicator to use. I don't need it to trade with, but I have it on my charts. Because typically, most times, if you're looking for a setup, and if the market is above the VWAP and it pulls back to a case, to like a demand area, you can look to go long. Okay, if the VWAP is above and the market's moving lower, you can look to go short. Just kind of throwing that out there. But the market, we get into the trade right here at 890. Well, not 892. If you're aggressive, you got in right here at 889. If you're more conservative, you got in the trade right here at 886 and a quarter. And you could take it all the way down to 50 if you can hold the trade. Now you may be saying, Mike, how do I allow myself? How do I stay in that trade so I can maximize profits when I'm in that winning trades? I want to stay in it longer, right? So what do you do? All right, so check this out. When the market is doing this right here, I'm going to show you. Let's bring up the we'll do this. So we're in the trade, say for instance right here, right? It pushes down, pulls back, break structure. We got to break a structure here to the downside, correct? Now, when it breaks structure and we're into the trade, say in this area right here, our break even is normally going to be right here, right? And we're going to have our stop resting at the back end right here. Okay, why? Because this is the supporting area or supporting swing area from where I got into my trade at. So my stop is going to be right here. My break even for where I enter the trade is probably going to be 887, and then my stop is probably going to be around 893, 895, and that's fair when it comes to the Nasdaq, a 5-point stop, because you know the market can swing on the Nasdaq 5-10 points pretty easy. But look what happens: you enter the trade, it pulls back, comes back to the break even, pushes lower. All right, I'm going to leave my stop where it's at. You know, I'm going to leave my stop where it's at until it makes the next swing down to the downside. Okay, to the downside. Once it does that, then I'm going to take my stop and move it below the right above the top end of the last swing where it moved to the downside. Right here, push down low, lower high. So at the lower high point, that's where I'm going to push my stop once we break structure right here. Now, I'm not going to move the stop again until we make another swing, make a low and a lower high, and then I'll position it at the back end of the lower high coming out of that swing. So we got a push to the downside here. Okay, we'll go back up here and we'll grab this here. Pushes up, lower high, and then it comes down again. Now I'm going to move in my stop even lower. So now by doing that, that locks my profit in from where I got in the trade. Let's say I got in right here at 886 and a quarter. Now I'm all the way down here with profits locked in at 875. Okay, does that make sense? Look, 886 and a quarter. Now we're down here at 75. So we done picked ourselves up 11 points right there. Easy. We're locked in on 11 points. We're not going to lose that 11 points. The market pulls back, break structure. We're locked in profit. It pushes down. Okay, and then it pulls back again. Okay, we're going to grab this again. Just showing you an example here. Pulls back again, breaks lower. Okay, now if we moved our stop lower the moment it broke structure right here to the downside, and we moved it down to 69. So now once we move it down to 60, how much profit have we locked in by doing that? Well, we locked in about 17 points right there, because now we've moved our, let me grab this again, moved our stop down to this area right here. The market swings back, it stops you out. You locked in 17 points. Okay, that's how you do it. Each time the market runs lower and swings, swing to downside, lower high, stop goes there, swings to the downside. Okay, lower high, break structure, move your stop right here. Swings to the downside, lower high, swings lower, break structure, move it here. So each time it does that, move your stop back at the lower high coming out of a swing where it just broke structure back to the downside again. All right. Now, yeah, we didn't capitalize, or you could maybe not have grabbed all the way down to 50. But if you left, say, for instance, your stop resting back up here, all right, and you kind of know what's going on, and you know, and you're looking back at your higher time frame chart and said the market's going to test this area here. There's an imbalance resting right here. It's already tested this area here. You know it's coming down to 50, then you can leave it right here, locked in at those pretty much 11 points right there, and see if it's going to run back. You know, sometimes it may do that. Sometimes it may come all the way back and stop you out right here. They could test deeper areas back to the upside before they start swinging back to the downside. So, you know, that's a part of trading. You know, we have to know where we want to take profit at, in a sense, or lock it in at, because the market's going to do what it wants to do. We can't capitalize and stay in every trade is what I'm trying to say. At some point, it may stop us out, and there's plenty of times where it just runs and we capitalize pretty well, meaning maximize our profits on nice swings or move to the downside. So this is how we stay in the trades longer. Those winning trades, we can make sure by doing so, by following this strategy or technique. Again, each time it closes lower and creates a lower high, we're going to bring our stop down behind it. All right, and that locks us into profit. So this is how I do it in my trading. You know, I try to, we're all working to become better traders. And this is something that I've started incorporating and working and making part of my own trading plan, to allow myself to maximize. You know, I think it was Friday and Thursday of last week, this past week, I got into this trade here and I collected what I think, it ran all the way down. I think I collected about 28 points on that move right there to the downside. Beautiful trade setup. Okay, and then on Friday, was this Friday's trade? Let me see right quick. Yeah, this was Friday's trade that I took. One moment, please. Let me see. No, I'm sorry. That was Thursday's trade. I took another one on Friday. It was a beautiful runner going to the upside. I'm sorry about that. Going to the upside. But yeah, I mean, this could be demand, supply. In this case here, this was off of a liquidity sweep setup. And then the market runs back up here. Okay, and if you had this mark off your lower time frame or lower base chart here, the 12 range as a supply area, the market breaks it right there to the upside. But it does unfold and give you another setup, because what it does is it goes back up there. This area here is what? A supply area off of a higher time frame. And once the market taps into that area, I'm just going to show you, for example, right here. Let's do this. We'll take this. Oh, didn't mean to do that. Just want to show you a quick example, so stay with me. Right here, this is a supply zone. Aggressive selling to the downside. I'm going to mark it so you can see it on the 12 range chart as well. Now we'll move down to the 12 range. Okay, this big box right here. All right, the market pulls back into it. What we want to look for then is a breaker structure below, and then maybe a pullback going lower. Okay, and as you can see here, as it taps into this supply zone here. Okay, supply zone off the higher time frame. It didn't give us a break until it broke right here, and then it pulled back. But if you notice right here, you're not going to take this trade right here, because now what you're doing is looking for a supply setup to unfold off of your lower time frame. The market broke through this area right here. So it made that supply area right here on the lower time frame and invalidated that. Okay, so in this case, but pay attention to what happened. All right, but look what did happen. It made a high here, low. Equal high right here, low, and then it sweeps this area here on the lower time frame into a higher time frame zone. Okay, all right, a supply zone off the 60 range chart. Sweeps. What do we do then? Once it sweeps that area there, all I'm looking for is a break and close on my 12 range chart, a break and close of a candle lower. Okay, because the sweep didn't happen on my 12 range, my higher time frame. It happened on my lower time frame, 12 range, into a 60 range or higher time frame zone. Break and close of the candle lower right here at 81, it goes all the way down to 59. All right. It's simple as that. I mean, trading, please do not overcomplicate your trading because it's not that hard. But that beautiful trade setup that I showed you off that sweep, that's how you can do it if you just move your stop as the market breaks, structure continuously to the downside. All right. As it's doing that and climbing lower, I'm going to show you back on a lower time frame. Let's do away with this box now. See, break structure, pulls back, break, stop goes here. Breaks lower, pulls back, breaks lower, stop goes here. Pulls back, breaks lower, stop goes here. But then it stops straight out because the market retested or started testing some slightly higher areas. It wicked out that area. Why did it wick that area out? Because they know people had their stops rested as the movements come as the movement is going to the downside. They're testing areas of liquidity. All right, they want to capitalize on some more areas of liquidity before they continue pushing lower, and that's what they did. But I just want to share that with you today. Hopefully, you guys can follow through what I'm trying to say. Go back, take your mental notes, watch this over and over, and practice it into your own trading and see if it helps you stay in your trades longer so that you can actually maximize profits. Simple as that. Again, if you're interested in joining the Discord, find the link down in the description portion of this video. If you're interested, because people always ask how they can become an elite member, all you have to do is click on the join button right here that you see in front of you on the somewhere on this video. You'll see it right there next to the download, share, subscribe button. There's a button that says join, or you can find a link to the to become an elite member down right below the Discord link in the description portion of the video as well. But that's if you choose to join or not. It's $6.99 a month. You're asking, what do you receive for doing that? Well, you're supporting me as a content creator. That's what it's all about through the YouTube tier membership program. So all the valuable content that I push out, it's just your means of supporting me as a content creator. And in return, what I give back is the trade breakdowns and the video playlist, which is a link-by-link series of videos that I've pulled away from, that I've taken out of the over 700 videos here on the channel and made them to a series, so you don't have to sit there and watch 700 videos. But again, that's if you choose to or not. It's just $6.99 a month. That's all it is. Trade breakdowns and then the link by link, or the links to the videos that I'm talking about. All right, that basically go into detail about the way I trade and just and the strategy I use and how I trade it on a daily basis. But that's if you choose to become an elite member or not. Outside of that, I appreciate everyone tuning in and watching the daily videos. We ramped back up this week for another hopefully successful trading week, and I wish everyone out there who's trading this week be safe, be successful, and take home some profits. Take care, and I'll see you in the next video.